Okay, let's do some questions on our various financial statement accounts. Let's start out with question number 8. The primary purpose of sending a standard confirmation request to financial institutions with which the client has done business during the year is to do what? Why do we send out a confirmation to financial institutions or banks? Why do we send out an AICPA standard bank confirmation? What does it tell us in there? It tells us about the account balances. It tells us if there's a direct liability. It tells us if there's a compensating balance. So it tells us a lot of different stuff. A, detect kiting activities that may otherwise not be discovered. Remember, we are concerned about kiting, the deliberate overstatement of cash by showing a deposit in X1 and the withdrawal in X2, but that's more of an interbank transfer schedule, not a bank confirmation. B, corroborate information regarding deposit and loan balances. Deposits, if we deposit money in there, our balance, and if we borrowed money, true, at December 31st. C, provide the data necessary for a proof of cash. We're not trying to proof of cash of anything. D, request information about contingent liabilities and secured transactions, not with a bank confirm. Best answer, B. Number 9, when an auditor does not receive replies to positive requests for year-end account receivable confirmations, the auditor would most likely what? All right, so we send out a positive. Do you expect a response on a positive? Yes. When do you not expect a response? Negative. So do you expect a response? Yes, we do. We don't get a response, then what do? Then we send a second. We don't get a response, we ask the client to contact them. They don't respond, we look at subsequent cash receipts. We don't get anything, we look at shipping documents. We don't look at it, we look at a confirmation file. We still don't have it, we might consider an audit adjustment. So, A, inspect the allowance account to verify whether the accounts were subsequently written off. No, not yet. B, increase the assessed level of detection risk for valuation. Hey, we have not, everything's wrong, let's increase our risk. Might be a little aggressive, a little premature. C, ask the client to contact the customers to request the confirmations be returned. Yes, send a second, ask them to respond. D, increase the assessed level of inherent risk for the revenue cycle. We're done with that. We're now looking at confirmations, which is a substantive test to substantiate or corroborate the assertions. Best answer is C. Number 10. In auditing accounts receivable, the negative form of confirmation request most likely would be used when? Negative says, hey, according to our records, everything's fine. If you disagree, let us know. Remember, no news is good news. It gives you implicit evidence. You use it when reliance is high, control risk, RMM is low. A, the total recorded amount of receivables is immaterial to the financial statements taken as a whole. Well, you probably would still send a few positives. B, response rates in previous years to properly designed positives were inadequate. If you don't think people are going to seriously consider them, don't use negatives, use positives. C, recipients are likely to return positives without verifying the accuracy, then maybe send a blank. D, the combined assessed level of inherent risk and control risk relative to accounts receivable is low. If it's low, reliance is high. Yes, then we'll use some negative form of confirmations. Number 11. An auditor most likely would make inquiries of production and sales personnel concerning possible obsolete or slow-moving inventory to support management's financial assertion of what? So when we look at obsolete, remember we talked about inventory. We said when you're doing an inventory observation, is the count correct? Price test, purchase and sales, damage and obsolescence. What does damage and obsolescence really tell us about slow moving? It tells us, well, we know it exists, we know they own it, we know it's right there, but it's not saleable. It tells us about what? Valuation.